This webinar is aimed at people who are within 10 years of their retirement date and is produced by Broadstone, a company regulated by the Financial Conduct Authority. The running time is 10 minutes. In the last few weeks, we have seen dramatic falls in the stock markets across the globe, and we know it's a worrying time for people with retirement plans on the horizon. This webinar will give you some ideas to help keep your pension plans on track. First of all, if you do have some spare cash, you could consider making a one-off additional contribution to your pension fund. You will get tax relief up to your highest marginal rate, which is effectively free money. And if the current market volatility concerns you, remember that most pension schemes offer cash funds or low-risk funds, which might be suitable for you in the short term. But a word of caution, there are limits to the contributions you can make and tax penalties if you exceed them. If in doubt, seek advice from a regulated financial advisor. And let's not forget ISAs, because they are a great way of saving for the future. They are free from income tax and capital gains tax and don't need to be declared on your tax return. You can subscribe up to £20,000 during the tax year 2021 to either a cash or a stocks and shares ISA, or you could use a combination of both. And from the 6th of April 2020, the limit for junior ISAs shoots up to £9,000 per tax year. And remember that cash ISAs can always be transferred to a stocks and shares ISA when you're ready to invest. So don't let the current market volatility stop you from using your ISA allowance. If you have a defined contribution pension, which allows flexi access, you can take up to 25% tax-free as a lump sum from the age of 55. However, did you realise that you don't have to take it all at once? You can take your tax-free cash in tranches if you like, as and when it suits you. Now, we know it's very hard not to worry during a market downturn. Nervous investors might even be tempted to encash or change their investments when things are going badly. But you should think carefully before doing anything extreme. Encashing or changing an investment is a big decision, and mistakes could significantly impact your long-term objectives. Always seek advice if you are in any doubt. Now, of course, your household income is going to reduce quite a lot in retirement. However, as you can see from the chart produced by the Office of National Statistics, you might find yourself spending more on certain things like healthcare or leisure activities. So think about the lifestyle you'll want in retirement and what your expenditure might be realistically. How much income will you need to cover it? If you'd like help, we can model a cash flow forecast, so please get in touch. However, we do make a charge for this service. The full new state pension payable from state pension age is currently £175.20 per week. But the actual amount you'll get depends on your national insurance record. So it's a good idea to obtain a forecast of your pension and check your state pension age. And you can do so at the website www.gov.uk. Do you know exactly what you've got in your pensions and investment schemes? If not, obtain an up-to-date valuation and check how they are invested. Do they match your long-term objectives and your attitude to risk? What are the charges? If you're lucky enough to have a final salary defined benefit pension, this will be based on your salary, not the stock market performance. You should receive a statement each year advising you of your projected pension at your retirement date. Be careful, though, about taking benefits early from a defined benefit pension, because the benefits might be reduced significantly. If you have any old pensions from previous employment, but have lost track of them, use this website to trace them, www.gov.uk/find pension contact details. And if you do have any old pensions which you've collected over the years, consideration can be given to consolidating them all together so that they're easier to manage. Depending on the type of scheme, there could be advantages because some old pension schemes may have high charges or may be inflexible. But there can be disadvantages. For example, there is no guarantee of a better pension, and you could be given up valuable benefits or guarantees by transferring. This is a complex area, and you are strongly advised to speak to a financial advisor before you make any decisions. Pension freedom legislation has made pensions much more flexible. The days when you had to buy an annuity are long gone. But annuities may still be attractive to anyone who is risk-averse. Enhanced life annuities are designed for people with medical conditions and pay slightly higher rates. So if you're thinking of taking an annuity, shop around. This is called taking the open market option, and a regulated financial advisor will be able to help you select the best type of annuity, the features you need, and will be able to search the market for the best available rate. Now, if you're a high earner, you'll be interested to know that the recent budget relaxed the rules relating to tapered annual allowance. From the 6th of April 2020, the limits for adjusted income and threshold income increased. So if you were previously restricted by the tapered annual allowance, it's worth checking whether you still are. It's possible that you might be able to contribute more to your pension from the 6th of April 2020. But a word to the wise, income in this context means from all sources, so it includes salary, bonuses, and other income that is liable to UK income tax, such as rental income. If you are thinking about making a large contribution to your pension, carry forward allows you to make contributions in excess of your annual allowance to maximise tax relief. It works by taking the unused portion of your allowances for the last 3 years and adding them to your current year's unused allowance. But be careful, you must have earnings in the current tax year equal to or more than the amount you want to contribute. Mistakes can result in an unexpected tax charge, so take advice if you are thinking of making a large contribution. Pension benefits are outside your estate when you die, so they will not, as many people believe, pass in accordance with your will. You will need to complete a nomination form and lodge this with your pension provider to ensure the death benefits are paid in accordance with your wishes. If you haven't completed one, you should contact your pension provider to arrange it. It's easy to do. Most providers allow it to be done online, or if you prefer, they will send you a pre-printed form to use. It's also a good idea to appoint a power of attorney. This allows you to select the person who you'd like to manage your affairs during illness or incapacity, rather than letting the court appoint someone for you. You can find more information at the website on screen, www.gov.uk/power of attorney. And last but not least, make a will. Professional advice can help make the most of your money as you plan for retirement. Your aims and objectives are individual to you, and ensuring you have the right financial plans in place is crucial to achieving them. But what about the cost? Well, the Pension Advice Allowance is a government scheme that lets you take out up to £500 tax-free from your pension to pay for retirement planning financial advice. There are some rules, however. You can only use the allowance once in any one tax year and a maximum of 3 times during your lifetime. It must be used for professional retirement planning advice, and the maximum amount at any one time is £500. It's also worth mentioning that not all schemes participate, so check whether the scheme you're paying into allows it. Well, thank you for listening. We are in unprecedented times. and we understand the anxiety that many people coming up to retirement will be feeling at the moment. Above all else, remember that your pension is a long-term investment, and it is usually better to resist making short-term, knee-jerk reactions. The best way to navigate through choppy waters is to have a sensible plan and focus on the long-term goal, and to make use of every tool at your disposal as you chart your course, such as using tax allowances and taking professional advice whenever you need some help. So, needless to say, if you do have any questions, please contact us here at Broadstone.